Hi, welcome back to Simply Accounting. In today's video, we will do a problem that includes accounts receivable and accounts payable. So in this problem, we have CM Small Appliance Shop, and so these are the accounts for as of January 1st, 2013. So the cash account balance was $2,000. Accounts receivable was $400, supplies was $500, equipment was $600, and accounts payable was, equipment was $6,000, and accounts payable was $900. So these are business transactions for the month of January. The first one is that your company received $100 on account from your customers. And that was a part payment, so that means that they didn't pay the full amount of their accounts receivable, so they have more money to pay you back. So for this first one, you will debit the cash account because you are receiving the $100 from the customer, and you would credit accounts receivable because the $100 they no longer owe you, so you would credit accounts receivable. So for the second one, it says that your company purchased $250 worth of supplies on account. So for this one, you would debit supplies for $250 because you're buying supplies, and then you would also credit accounts payable for $250 because $250 is what you owe the business because you didn't pay for the supplies with cash. You promised to pay them out at a later date. And accounts payable, it would be a credit because the beginning balance for accounts payable is a credit, so you credit accounts payable to increase the account. So the third transaction says that you paid your creditor $200 on account, and that was a part payment also, so that means that you still have more money to pay back. So for this one, you would credit cash for $200 because you are paying the $200, and then you would debit accounts payable, which means that you're going to decrease this account because the $200 you no longer owe to your creditor. And then the last transaction says that you purchased equipment for $800, giving $200 worth of cash and promising to pay the rest of the balance in 60 days. So for this one, first you would credit cash for $200 because that is the amount that you're paying, that you can pay with cash. And then you would debit equipment for $800 because you're increasing your equipment account. And then the rest of the amount, which is $600, because you do 800 minus 200, which is 600, that would be a credit to accounts payable because that is the amount that you still owe to the business that you purchased the equipment from. So after doing all the transactions, you would add the transactions for your T accounts on both sides. So for cash, you would add the $2,000 plus the $100. So that gives you a total on the debit side of $2,100. And you add what you have on your credit side, which is $200 plus $200, which is $400. So then you would subtract $400 from $2,100, so that would give you an ending balance of $1,700, and that would be on the debit side of the T account. So for accounts receivable, you have a beginning balance of $400, and then you had the one transaction of $100. So you would subtract $100 from $400, and that would give you an ending balance of $300. So for supplies, you had no transactions that were a credit to the supplies account, so you would just add the $500 plus the $250 to give you an ending balance of $750. For equipment, it's the same thing. You had no transactions on the credit side of the T account, So you would just add up the two transactions on the debit side of your T account, and you get an ending balance of $6,800. Now for accounts payable, you have a beginning balance of $900, and then you would add the $250 and the $600 to give you a balance of $1,750 on the credit side of your T account, and then you have one transaction on the debit side, which was $200. So you would subtract $200 from $1,750, and you would get an ending balance of $1,550 on the credit side of the T account for accounts payable. Okay, so I hope that you learned and understood everything that I taught you today, and I hope to see you next week on Simply Accounting.